Hey everyone, back again for another Monday edition of That's Our Two Satoshis Live. For those who don't know, this is Arca's version of what's going on in the markets in digital assets based on the blog that we write every week, which you can find at ar.ca. This week, I am joined by Nick Coates, who most of you probably know. He's joined me many times in the past, but how you doing today, Nick?
Doing well, Jeff. How are you?
I'm good. I'm good. All right, man. Well, as a leading indicator on everything blockchain and macro related, as you saw, what I wrote about last night was a lot of gibberish about the same things we've been talking about for 2 or 3 months, which is there anything other than macro that is going on, and when will these correlations end, and how much do we have to listen to the Fed? So the base case of what I was writing about was that, look, I'll give you a little history lesson for those listening, which is, I was on Wall Street for about 15 years doing debt and equities, and I used to love it. I was the guy who read 10Ks and 10Qs and read credit agreements, and I knew everything about these companies, and for a long time that mattered. And then right around 2009, 2010, 2011, my job became incredibly boring because all we were doing was waiting every 6 weeks to see what the Fed said, and then we were either max long or max underweight depending on that. And I left. I left Wall Street because it was boring me to tears. And fortunately, over the last 5 years, I got involved in digital assets, started Arca, and it's been rejuvenating. It's been the most exciting thing I've ever done because it's really interesting watching what drives prices. Up until about 2 months ago. So, what's going on in the macro world? Will we ever snap out of this? And why is this so important to digital assets that even last week market's doing fine until Brainerd speaks, and all of a sudden, equities and digital assets come crumbling down again.
Yeah, and I think, well, at least I definitely hope that there is still room for that fundamental analysis. I think right now and even I'm sure as you kind of experienced, earlier on in your career, it's just about the volatility and what people think about monetary policy, right? So if people are rapidly changing their expectations of what's going on, that's going to disproportionately affect the fundamentals of all the assets you're looking at, more so than like the cash flows that the businesses are generating, or how likely they are to go bankrupt. I'm not a credit guy, so that's more your speed. But
Sure.
And right now, people are really well. The Fed is explicitly saying that they're really concerned about inflation, and you're seeing prints go up in the U.S. and Europe, even seeing it in China now. Really, basically throughout the world, outside of Japan, pretty much. And central banks are responding to that. And I think that there was a lot of offsides pricing. Certainly, I was one of those people who wasn't as worried about inflation as I probably should have been. And now I believe the Fed when they're saying, this is our number one priority, and we really need to do something about this.
So how do we? And I agree with that as well. I think it's pretty clear the Fed is certainly not hiding anything. I've been saying for years now that this Fed under Powell is the most transparent we've ever seen to a fault. Right? They are not trying to hide anything. They're telling you explicitly exactly what they're planning on doing. The question is, they did the same thing 2 years ago, and it was the exact opposite, right? All they talked about was low inflation as one of the major challenges of our time. And we put a screenshot in the write up for those who are following along and looking at the blog. But all these different Fed speakers and government officials who were talking about how low inflation was and how it's such a risk and we have to bring it higher. And they weren't able to do it for 2 years, and then all of a sudden it did happen, and it was way more than they expected. So how much do you actually believe that the Fed has any control or even any foresight into what's happening versus just it's their job to kind of talk the market down and deliver the expectations?
I think that there's a distinction between how much foresight the Fed has and how much they can do about it. I think, like especially say 2018 or whenever when the Fed is trying to create inflation, um, there's a little bit they can do about it. Like there is some evidence that like quantitative easing, for example, can boost inflation, but really can't do all that much. The big drivers of growth and inflation in the economy are the government printing money, which is like running deficits, and banks printing new money, which is creating new loans. And the central bank can't really do all that much about it. Now that's exacerbated by the fact now that most of the inflation is driven by these supply chain issues that you've had related to the kind of COVID spikes, Delta, and now Omicron. Certainly there is an element of the fiscal printing that happened last year, kind of washing over the economy and adding to prices. But the Fed can only do so much to kind of get in the way of that. Well, I shouldn't say that. I guess the Fed can do a fair bit to kind of bring down the economy, and I really think that is what it's relying on to bring down inflation. And so you have interest rate hikes. That's why they're going. What is it? 9 hikes now. QT coming up. They're kind of relying on that negative wealth effect, which is we're going to bring down asset prices to reduce the amount of that people consume, and that's going to increase unemployment and eventually reduce inflation. I think that's the calculus right now.
Sure, but let's talk. So you mentioned there's only a few things the Fed has control over, and a lot of it really is more about the banks, right? We've seen basically for the last 6 to 9 months, right around $1.5 trillion of reverse repo, which is effectively banks have money that they don't even know what to do with. So it is more cost effective for them to park it with the Fed and earn a sliver interest rate from them than it is to do anything with it. Once the Fed withdraws liquidity, which is what Brainerd spoke about last week, is that they're going to start to eventually not only pull back on the QE, but actually start the QT and actually start to withdraw some of that liquidity. Won't that just get replaced by the banks who are sitting on all this cash and haven't been using it for the last 2 years? If the Fed removes liquidity, the banks will step up their lending?
I mean, this is kind of getting more to the internals of like how the system works, and I don't count myself as an expert, but my take is that a lot of that money that they're currently getting on reverse repo is just safe assets that they need for reserves, and it's not necessarily going to go into like new loans or especially to like the stock market or the crypto market or something once that if that ends, once that liquidity goes away.
Yeah, my thesis on what the Fed is doing is I think, they know that they're wrong, that they were wrong and too slow to act. And I think that they also are quite cognizant of what you just said, which is that there's only so much they can really do. If any part of this inflationary pressure is transitory, which I think we all know at least some of it is due to the supply issues that you mentioned with regard to Omicron, the longer that they wait to hike rates, the less likely they will actually have to hike rates. So if they basically foreshadow that they're going to do it and tell the markets that they're going to do it and have the markets increase rates for them, even though the 2-year now at 260, while the Fed funds rate is still at only 25 basis points, basically it just buys them time, right? They're not going to just all of a sudden raise rates 200 basis points at the next meeting. They're still going to go methodically 25 basis points or 50 basis points at a time. But they're going to continue to talk the market into that we're going to be aggressive, And if over that optionality that they buy themselves, that time value that they buy themselves, if you start to see any of these pressures start to subside, it gives them an out from having to be as aggressive as they say.
I think that makes a lot of sense. The Fed needs to, like you were talking about in the note, preserve their credibility and try to bring down inflation to some extent. And like we were saying, it is transitory to a large extent. And as long as they can preserve their credibility through that, that's really, that's having your cake and eating it too. Now, whether they can actually do that or how long the inflation is persistent and sticky at these really high levels that are materially hurting the consumer, that's the harder part.
Yeah. And let's get back to what it means for digital assets. I mean, I've been writing this weekly blog for over 4 years now. I've written about correlations, at least 6 or 7 different correlations over the course of this 4 years. Right? I've talked about everything from correlation to equities to correlation to the digital, to the Chinese yuan, to correlations with the dollar, to gold, to oil, even avocados, in a jokingly way, just because the correlation is high. We're clearly seeing the highest correlation to the Nasdaq we've ever seen. On a 90-day basis, this is the highest the ETH and the Nasdaq have been correlated at about 0.62 than really ever in the last, I think, 3 or 4 years. On the one hand, that's concerning. On the other hand, it's probably just a footnote in the sense that we'll eventually find a new correlation over time. But I think what's probably more interesting is if you actually just go back 1 year. Think back to the beginning of 2021, where we had January 2021 was just DeFi was up a couple 100%. February 2021, it was CFI, it was BNB and FTX. March of 2021 was Web3, things like Audius and Chili's and Helium. April 2021 was, your meme coins, your Doge coins, your Shibas. But if you go back, exactly 1 year, so April 11th, 2021, the total market cap of digital assets is basically unchanged. It's been right around 2 trillion a year ago, and it's right around 2 trillion now. We've had a ton of ups and downs over that time period, but really the overall market cap hasn't moved that much. It's just been a lot of rotation. You've seen DeFi down while gaming is up. You've seen Bitcoin down while protocols are up. And I think the same thing is true now, which is that we've just been in a giant range for a year. And the fact that we happen to be heavily correlated to equities is sort of less relevant than the fact that just we haven't really had a meaningful catalyst in the last year that has brought real new innovation or new adoption or new money into the system, right? The new money is coming in the form of venture capital, funding new projects left and right. But you just haven't seen a wave of new money come in really since the fourth quarter of 2020. In my opinion, I've written about this and spoken about it with you, over the last couple of months, is that I think that next catalyst actually just came. I think what happened in February of 2022 with Canada sanctioning their own citizens and Russia causing a depression and the US and Europe, sanctioning Russia with SWIFT, even what the London Metal Exchange did in terms of just canceling trades. I think we're going to look back in history and point to February and March of 2022 and say this was a turning point. This was the time period where people started to realize that their money was not actually theirs. It was somebody else's liability that you may or may not actually ever get back. But that doesn't necessarily trickle into prices yet. So anyway, long story short is I think there's a good chance that this equity correlation is just sort of a snapshot in time of just something to latch onto while there's nothing else going on. But we need a meaningful, real catalyst to kind of get us to that next level. That's going to have nothing to do with equities or the Fed.
Yeah, and there's a lot there, but in general, the point on the correlations, I agree with you to an extent. I think that there is the different sectors of that we consider now within the digital asset space will eventually decouple, and that means that they'll decouple from the various macro forces too, right? So there's no real reason why Bitcoin or Ethereum or Solana should be correlated to the stock market, like they're commodities or currencies, something like that. And there's not a great reason why DeFi should be correlated to tech stocks, right? It should be coordinated to financials. It's a financial technology. And you've seen financial stocks hold in pretty well over the last couple of months because interest rates have gone up so much. Despite the rest of the market kind of, especially the tech sector, kind of buckling. But I mean, definitely things like Web3 type applications or metaverse gaming tokens, things like that. I think there's a pretty good case for those to be continue to be correlated to the technology stocks because they're essentially technology businesses that have these cash flows out in the future somewhere, and that's essentially the same business model.
Yeah, I totally agree with that, and I think I've spoken about this before as well, but I think the correlations that you see in digital assets are largely based on who is involved in the market, less so than what they're actually investing in at this point. Meaning, it's still a pretty small ecosystem, right? You got a handful of macro funds who are big in the space. You've got a handful of your market making firms, your Alamedas and your Jumps that handle the majority of the volume. You've got a handful of $1 billion plus crypto native funds. It's a very small, limited universe of real players in the space right now, and what they're doing and their actions is much more relevant right now than what the actual assets are. As this industry grows, and you start to see more financial advisors getting their customers in the space, and more long only mutual funds or index based funds, then you start to smooth out and diversify that ownership. And once you see that, then I think the things you're talking about start to take hold, which is that DeFi will be more correlated with banks, and cash flow producing tokens will be more defensive than something that isn't cash flow producing like a Bitcoin. But we may be a long way away from that. I think for the time being, all eyes are on the Fed, all eyes are on CPI report tomorrow, all eyes are on what the Nasdaq does. but it's almost certain that won't be the lasting legacy of digital assets. So they're just going to be correlated to equities forever. So I think this will break.
You forgot to mention the kind of elephant in the room, which is, digital asset funds that are actually discriminating between the various sectors and, thinking about what the correlation should be.
Yeah, absolutely. Right. And as more money comes into those types of funds who are more who are doing more actual sector by sector work and fundamental work, that naturally leads to bigger dispersions between different parts of the digital asset economy. Okay, speaking of tech, last thing real quick. Did you see all the news around Elon Musk and buying a 9% stake in Twitter?
Yeah, I don't know if I caught every tweet, but I saw most of it.
Well, I thought the most interesting takeaway for this was, not only the markets, just love for Elon Musk and everything he does and says, but the fact that immediately Musk started to put polls out there on Twitter on some of the things that Twitter should do, including, do you want an edit button? And I'm looking at the tweet right now. It had 4.5 million votes, 342,000 likes, 83,000 retweets, and 73% of people said yes, they wanted an edit button, even though Musk spelled yes wrong in his poll. The interesting thing for me is not the poll or the edit button. The interesting thing to me is this just sheds a light on how ridiculous some of the solutions are for companies where, to me, it's so obvious that they should just have a token. Meaning, Twitter has a $37 billion equity market cap. They have certainly, underperformed, I would say, other tech companies based on the fact that they have 400 million daily active users and have, largely probably the most important platform in terms of news dissemination, in the world right now. If Twitter had a token and that token looked something similar to what we've seen from other, hybrid tokens, maybe 10 to 20% of top line revenue gets distributed to token holders. Token holders have governance rights over the platform's features, including an edit button. The ability for token holders to maybe lock up some of their Twitter tokens to earn more tokens via inflationary rewards, maybe something like tweet to earn or like to earn. Do you think that Twitter token would immediately have a higher market cap than the equity market cap of Twitter, which is 37 billion?
So I was listening to the podcast on Real Vision with Punk 6529. The guy who always tweets about NFTs. And so he and Raul Paul were talking, and he was talking about digital assets as like a comparable to intangibles on companies' balance sheets, and saying like, if this is the key that unlocks intangibles, well, those are the most valuable asset known to man, worth like hundreds of trillions of dollars, right? And governance of Twitter platform, that's just one of those intangibles that people they value it, but it's not something that we can put a price on currently, and that token unlocks that. So I mean, yeah, I don't see any reason why you don't decentralize this and give those governance rights some value and let people assign it some value. Yeah, I think it definitely is probably worth more than the Twitter stock.
Yeah, I think so too, and I think you can go way beyond just Twitter. I think it's Netflix and Disney and Starbucks and Delta Airlines and you name it. Any of these companies that have a very large, sticky, passionate customer base. If they were able to issue a token in the same way that we've seen from other entities within the digital asset world, I think it immediately unlocks so much value in these companies. Whether it's intangibles or whether you just call it a claim on kind of future customer growth or loyalty or stickiness, it's a home run. And the fact that there aren't creative investment bankers pitching this yet, the fact that we don't have regulatory clarity, at least here in the US, the fact that companies aren't even thinking this way, to me, that's probably one of the most bullish aspects of digital assets, is that we've come as far as we have with the crop of tokens that exist to date. And we haven't even seen the ones that are going to ultimately be, in the top 10 5 years from now, right? The top 10 is going to look like the Fortune 500 pretty soon, where it's going to be these large companies with these, massive user bases and a token on their balance sheet. So I think it's a wasted opportunity. Again, not to say that everything Elon Musk does comes to reality. I think we all know that's not true. But if you're going to have a platform and you're going to, take the stake here and you're going to start pitching ideas, especially given his knowledge of digital assets and his interest in things like Dogecoin, I would be surprised if we don't see some sort of creative thinking from him along the lines of a token here, rather than just basic boring edit buttons to Twitter.
Yeah, I mean, and you've seen Twitter, make some sort of allusions to kind of the digital asset space. They've done some stuff with verifying NFTs. I know that's supposed to roll out here in the future, so they certainly have some interest on it. I'd be curious what you think over or under 5 years that they do something like that.
No, I think it's way under.
Under?
Way under. I think we're talking 3 years most, probably even 18 months to 2 years. So
Wow.
we'll see.
Okay.
So we shall
Exciting.
see. All right,
Looking
Nick.
forward to my Twitter airdrop.
Yeah, it'd be nice. You've earned it, pal. Speaking of Twitter, you can follow Nick on Twitter at Nick_hosts. You can follow Arca at ARCA. You can follow myself at JDorman81. And I encourage people to check out the blog at ar.ca. And we'll be back again next week with more thoughts on the digital asset market. Thanks for joining, everyone. And thank you, Nick.
Yeah, thank you, Jeff. See everybody.